In this week's update, market breadth continues to fly a cautionary flag. What about the ETF effect? And how to make headway in the Australian market? My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, we'll start with the usual market perspective, but today I'm going to start with a stock because it's really important stock. Sets the sentiment for pretty much the rest of the world. And this is NVIDIA. You'd need to be living under a rock not to know about what's been happening with NVIDIA in the last year or so. We had a very substantial reversal on Thursday night in the US. This is a very meaningful candle on rising volume. And normally, 9 times out of 10, you would say that the probability of this following through somewhat significantly to the downside is very real. And that's what this pattern would normally trace out. Now, Friday night, the market tried to sell off, but steadied, and it wasn't too bad. So it's a bit indecisive. So it raises a couple of questions. Is this a classic reversal that leads to a medium-term top being 2 months to maybe 4 or 5 or 6 months and getting reinforced by the ETF cycle? So when stocks are rising, the ETF fund managers are obliged to buy them, and it creates an upward momentum that feeds on itself. But of course, that process can go into reversal from time to time, and does, where if a stock starts to be sold, then the ETFs have to sell that stock, which then creates more selling, which creates more selling. And so you get this reinforcement cycle to the downside. So that's one possibility. The second possibility, it was the main options expiry week for the month in the US on Friday. And often we see quite blatant market manipulation by market makers to push the prices down for a period of a few days because it's to their financial benefit to do so. They have an incentive to do that. So that's another possibility. And if that is what was behind Thursday and Friday night selling, then frankly, there is nothing to see here, and life will go back to normal in the first few days of next week. The third alternative is that it's not really options related, but it's just a normal process of profit taking. 2 or 3 steps forward, 1 step back. You look at this candle here on the 7th of March. Reasonably similar candle. This was probably a little more extended in price above the moving averages, but not a lot. So we got a very similar pattern of a significant reversal followed by an undecided day. And then we tracked sideways from the 11th of March until we got a low on the 19th of April. So about 5.5 weeks. And then it just turned around and went straight back up again from 80 to 140. So is this another one of these? And of course, the answer at the moment is we don't know. At the moment, I'm standing somewhere in the middle because I don't know. And so therefore, I default to just managing risk rather than trying to guess at something. So I'm just standing in the middle. I'm neutral on what the outcome may be over the next few months with stocks like NVIDIA, and therefore the whole big tech sector, and therefore sentiment around the world. So even though you may not trade in the States and you may not be the least bit interested in these sort of stocks, they do impact the sentiment for everybody else. So it is important to understand. So I'm sort of standing in the middle. I'm neutral. If I see a good opportunity, I'll still buy it, but I'm going to be a bit more discerning on entry price and probably just a little bit more willing to take a bit of profit off the table. That's the sort of the risk management stance that I'm taking at the moment. Okay, that was an important chart to start with. Now, the US indices are dominated by a few stocks. There's no question about that. And the question is, are punters directly cascading these stocks higher? So are they out there buying NVIDIA and Microsoft and Apple and Google and all those stocks because they really like them? Or is there a passive ETF impact, as I described earlier? Buying begets more buying. The answer is, I don't really know, but it's probably a combination of both. And retail investor sentiment can change on a dime, and certainly the passive ETF effect, once it reverses, is going to continue for a little bit. So that could be significant. So there's definitely a virtuous cycle that involves passive ETFs until it reverses, and then it can get a bit nasty. However, the medium to long-term outlook for semiconductors and AI and all those sort of things is sufficiently robust that this is almost certainly going to be a temporary situation. So you just need to examine your purposes and timeframes. That's the important thing. And now there are three kinds of stocks, whether it be America or Australia, as I would sort of classify them. There's the stocks that are trading on pretty high to excessively high PE multiples, but frankly, the quality of the business and the growth in earnings deserve it. These are the best of the best. They've traded on very high PE multiples for years, and they probably will continue to do so as long as their growth continues. So that's one kind of stock. And that is the type of stock that I focus on extremely heavily and encourage members to have somewhere between 50 and 80% of their portfolio devoted to those sorts of stocks. Because A, they're providing some of the best returns that are available on the market, but more than that, they're providing those returns with the highest degree of probability. Yes, you can make 500% gain on some specky mining stock, but that is far from reproducible, and it's incredibly high risk sort of stocks. I'm talking about are the ones that are producing well above average long-term returns and doing it with a very high degree of probability. So that's the first type. The second type are stocks that have got outstanding growth relative to their PE. Some of them are cheap, so they might have growth rates of 40, 50, 60% per annum in earnings, but be trading on PE multiples of 10 or 12. They present enormous investing opportunity. And the market likes them, and they've got upward momentum, and they tick all those boxes. And then the third kind of stock is everything else, which is the vast majority of the market. And in my opinion, that's what needs to be avoided. Because at best, you're going to get a substandard return, and at worst, you're going to lose money. So, as I've been saying for years now, I don't invest or trade in the stock market. I invest or trade in a small sliver of the stock market where the stocks offer the best risk-adjusted returns that I can find. So I just pose the question, why would you own stocks that either aren't value, aren't growing, and have no momentum? Why would you do that? And I'll come back to that point shortly. Now, just a bit of a word of warning on the local economy, and this is not, I don't mean to be, political in any way here. To me, this is just the reality. And of course, nothing is certain because, government policy and responses can always change. But as things stand at the moment, a lot of things are heading in the wrong direction. I don't think anyone would argue with the fact that our energy system is a complete disgrace. And how it pans out in the next 1 to 5 years is anybody's guess. We've got parties, all sides of politics, pursuing ideologies instead of practical solutions, and that's going to be to the detriment of all of us. We've got GDP growing pretty much only due to migration, and that brings all its own issues around infrastructure and housing and cost of living and so on and so forth that I'm sure that everybody's sick of hearing about and sick of experiencing. We've been uncompetitive on a global scale from, if you're looking at things like manufacturing, for a long, long period of time. We've lost a lot of manufacturing industries. And that's not getting any better, it's getting worse. We're becoming disastrously uncompetitive. And now we have a government who is trying to convince us that we're going to become a renewable energy superpower. Governments can't run anything profitably. And how we're going to do that in the environment that we're in is a complete mystery to me. We've got a push for more pay for less work. That should end well, I would imagine. And in some quarters, we've got an anti-resource sentiment that's gaining some momentum in some areas. I don't know how these people think we're going to pay the bills if we turn off or are forced to turn off our resource industries. It's craziness. It really is craziness. So what does that mean for stocks? So this is the point. So that wasn't meant to be a political rant. It's setting the scene for what is the most important question for us as investors, and what does it mean for stocks? The overwhelming odds are that only the very, very best in Australia will survive and thrive. So if you've been pursuing the broad-based diversification theme and think that's a good way to manage risk, well, it's a way, but it's not a very good one. In fact, I think it's a terrible one, and I've been saying that for years as well. So the focus only on the very, very best is just getting more and more critical. I think the Australian market is going to become more and more bifurcated in terms of what works and what doesn't. So just sit back and ask yourself the question, how can we have a robust corporate sector in the face of the headwinds that we're facing around energy, around costs, around cost of living? It defies any sort of reasonable logic. So from my perspective as an investor, I think you must know what let's call it the sweet minority are, and how to invest in that sweet minority with a clear plan. Because, you can buy the best of the best, but if you pay too much for them and you don't manage risk along the journey, then you can end up doing pretty poorly. So it's not just a matter of knowing what are the best of the best. You've got to have a process to go with that, and then you got to have the discipline to stick to that process. So from my perspective, and I don't set out just to look for stocks that have got big global businesses. I analyse every stock on its merits, but the ones that I tend to invest in just also happen to be global businesses. They're not reliant on the local economy. So all the time I'm trying to de-risk as much as I possibly can. Gravitate towards stocks that have got the highest probability of moving forward. So it gets down to clarity around what your purpose is, on owning that investment, what your timeframes are, and also around your entry and exit techniques. So there's a bit of a market perspective for you, a bit of a slap in the face for some, but look, you've just got to face reality. The direction that the Australian economy is heading in is not that conducive to lots and lots of corporate growth. It just isn't. So therefore, you've really got to fine-tune down your selection list. Moving now to America, the S&P ended up 0.6% across the week. The NASDAQ was doing well until Thursday and Friday when we got that sell-off in big tech. Still managed to record a slight gain, but the first part of next week will be very, very important. Now, the last few weeks I've been talking about the equal weight S&P index, RSP, and it's been lagging. It was sort of flat to slightly down when the S&P and the NASDAQ were up strongly. Interestingly, with that bit of a sell-off in big tech, we actually saw the equal weight S&P actually do a lot better, and it was up 1.1%. So slight head scratcher, but look, that's only one data point. A heck of a lot depends on how the market treats NVIDIA and the rest of the big techs next week. But whatever happens, there will still be sectors and stocks that will do very well. And some of my favourite growth stocks in America have been getting a bit of selling over the last couple of months. And so there are opportunities in other areas, certainly in some of the industrial areas, in some of the consumer discretionary areas. So look for signs, of rotation because there are some very, very good growth stocks in those other areas now that have had some selling. And the odds are now that that selling is perhaps done and we could see some good upside. So look out for that. The US dollar index was higher again, almost back to 106. The 10-year yield was steady at 4.26 and the VIX was up very slightly at 13.2. Let's go back to the charts. So there's the S&P, a little bit of a gain, but certainly closed off its highs for the week. But that's the RSP on a weekly chart, so not a bad net gain on RSP. And there's NASDAQ, just to finalise that trio. Now, getting down into the sectors and the industry groups, this is SMH, semiconductors, and that looks, as you would expect, almost identical to NVIDIA because NVIDIA is sort of swapping places with Microsoft as the world's highest market cap company. And so therefore has a very, very significant effect on SMH. And that's semiconductors versus the S&P. It's still enormously strong, and we certainly need more evidence than what we had in the last 2 days of last week. Relative comparison over the last month is really no real change from what we looked at last week, so I won't spend too much time on that. We just don't have enough information yet that this is a reversal of any meaningful amount. And in Australia, again, all the order is all pretty much the same. The only notable thing is that materials continue to really suffer, and sentiment towards material stocks in Australia is really looking very sad at the moment. All right, turning to Australia, our dollar ended up just below 66. Our index was up 0.6% across the week. And it was interesting, the Australian market actually did okay on Friday, considering the sharp tech selling in America on Thursday night. So maybe the Australian market just recognised that it was options expiry week and ignored it. Anyway, we will find out. The worst last week, IT and materials, for pretty well-known reasons. The leaders, healthcare and utilities, were up. Utilities was the strongest part of the market. So perhaps a bit of a move to a more conservative stance. Lithium stocks got absolutely butchered. And I think this is too early, but is this peak pessimism for lithium? I mean, you couldn't get sentiment any worse towards the lithium sector than it is at the moment. So, yeah, I don't know, but I'm certainly not advocating that this is the bottom in the cycle. It might be for lithium product prices, but I've got a suspicion that we're still going to see some meaningful downside in lithium stocks yet. That's certainly what the charts are saying. Now, there was a report out by Morgan Stanley during the week, which seemed to me to be reasonably balanced, but certainly very pessimistic about lithium prices moving higher over the next 3 to 4 years. Their view was they would stay down because supply was going to swamp the increasing demand. So that's one stance, and the market has reacted very badly to that. On the other side, we've got Pilbara Mines, who announced the results of their study, which showed a further doubling from 1 million tonnes a year to 2 million tonnes a year. So they've obviously still got terrific confidence in the lithium story. I suspect that part of it is around timeframes. Pilbara Mines investing with a 10 and 20-year view, Morgan Stanley talking about the next couple of years only. So perhaps those two views can coexist together. But at the moment, the lithium sector is, you're a very brave person to have very much exposure to the lithium sector. So in the face of all these unknowns, where you just can't be sure that the fundamentals are not going to change, you can't be sure about how prices are going to react, then what do? Well, as I've been saying again for years, focus on what we can control. There's a lot of stuff out there we can't control, so just ignore that, forget it. Just manage risk well, and there's lots of things that we can do to manage risk, and just do that and forget about everything else. It's a pretty simple process. It works for me, and it de-stresses the whole process of investing. The final point I make about the Aussie market is we've got the manufacturing PMI data showing that we're now in contraction, which is, of course, no surprise at all, given what I covered earlier on. So, sadly, it's not a terrific corporate message for the Australian market. Turning now to precious metals. Gold was down $10 to 23.22. Silver was unchanged, but silver has lost momentum. And if you look at it on the short-term chart, it's actually in short-term downtrend, lower highs, lower lows. So that breakout that we had a short while ago has fallen apart. If we look at the actual stocks themselves, in Australia, most development stocks are being left behind. And it's around, it would seem to be mostly around the fear about capital raisings and financing the projects. So there's two things here. One is the long-term financing of the project, whether it be 300 million or 1.5 billion. And this doesn't apply just to precious metals. It applies to pretty much the whole critical minerals space. So the project financing apparently is becoming more and more difficult. Banks becoming less and less willing to lend. And then there's the other part, which is keeping the lights on and doing a level of exploration to move yourself forward. And because the market is anticipating significant capital raisings, the prices are being marked down in advance. And that's just, again, creating this downward spiral. It's making it very difficult for businesses wanting to raise capital. And because they're now having to raise capital at depressed share prices, they either have to get more dilution or they have to accept less in the capital raising. None of these things are good for the buoyancy of share prices. And that's just the reality that we've got in the precious metals market and in other markets as well. All right, let's deal with the other commodities. Copper was down again a little bit, not much, few cents, 444. Nickel was at 785. And as I was talking about with gold, development stocks in the critical metals are facing the same financing dilemma. And that is a large part of the drag on these share prices. And the further out the projects are, the more they're suffering from this impact. So I think you got to face reality, and that is that these stocks are going to struggle for a little while, and particularly the ones that may not be in production until 2028 or 2030. You may not see any sort of movement in the share price for quite some time. That's just the reality, I'm afraid. Crude oil was up to $80.59. And there we go. So we've had a nice bounce back in crude oil. So just wrapping it up and trying to be as productive as I can, I get to talk to lots and lots of people, and I still see an overwhelming predominance of investors who do things by habit. It's the way they've always done things. They don't ever stop to think, is there a smarter way to do things? So don't get caught out by being locked into habit, being locked into the old wives' tale, the generally accepted conventions, which don't actually hold water at all, like sell in May and go away, for instance. Don't get caught out by the media hype, because just, acknowledge that at the peaks of negative and positive sentiment, the market is very close to reversing. And that's generally when the media is supporting that particular stance. Take a fresh look at everything that you do relative to your objectives. And just ask yourself, are you buying the best stocks available? Are you buying the highest probability growth stocks that are available? Because if you're not buying growth stocks, then potentially you're in a lot of trouble for the reasons that I outlined before. I think the Australian economy is heading in a poor direction. Or are you just undecided or unsure about the way forward? And I talk to plenty of people who sit in that category as well. And then, of course, there's everybody else who doesn't even know whether they're on the right path or not. So we are moving more and more towards a more difficult stock market environment. And you've just got to be better, smarter, slicker at what you do if you want to make a well above average return. That's the reality. Portfolio analysts last week certainly reflected that. We looked at the recommendations record, or where I make strong recommendations in Portfolio Analyst, which is only a minority of the stocks that get analysed, the small minority. We looked at that record and it was pretty impressive. If you want to have a look for yourself, take the $1 trial for 2 weeks into Portfolio Analyst, and I think you'll be pleased that you did. We also looked at the best ways of using Portfolio Analyst in the most profitable fashion as well, because there are, you can approach Portfolio Analyst in a very superficial way, or you can understand that there are lots and lots of things on offer in that service. So that's it for this week. There's more information on the website. There's my email address, and I will be back with you next Sunday. Cheers.